Start in the thick of it. The owner of a private enterprise sees the day-to-day reality firsthand. They monitor the real-time cash flow, they navigate the supply chain bottlenecks, and they feel the immediate pressure of payroll deadlines. But step outside the building, and that visibility vanishes. A commercial lender reviewing a loan application or a minority investor tracking their capital is completely blind to those daily operational pressures. This creates a distance between the internal operational reality of the company and the external market trying to understand it. We call this the information gap. When this gap is wide, external users face severe economic risks. Without reliable, structured data, they misprice credit, misunderstand cash flow capacity, and make poor investment decisions. There is a common assumption in the market that handing over internal management accounts or a recent tax return solves this problem. It does not.
Raw operational data is messy, and tax filings are built to satisfy government policy, not to measure economic health. To build external trust, businesses need a dedicated translation layer, a framework that converts ground floor reality into standardized, measurable risk. This document is that translation layer. The IFRS for SMEs accounting standard, now in its third edition, is explicitly engineered to provide practical reporting for small and medium entities. Tax rules follow fiscal policy to calculate what you owe the government. Management reporting serves internal control to run daily operations. General-purpose financial statements serve an entirely different audience. They are built specifically for external users, like creditors and rating agencies, who need reliable financial information but lack the legal authority to demand customized reports. The standard bridges the information gap by keeping the rigorous discipline of accrual accounting while stripping away the complex disclosures required for public capital markets. It actively balances the cost to the preparer against the specific data benefits required by an SME user. The framework operates as an independent architecture, built from the ground up for an audience with distinct information needs. A persistent misconception in the industry is that the physical size of a company dictates its eligibility to use this standard. The framework actually ignores revenue thresholds, asset size, and employee counts. As this matrix shows, the true filter for eligibility is public accountability. A massive private manufacturing group qualifies entirely simply because it has zero public accountability. Conversely, a tiny startup is disqualified if it issues traded debt or equity. Public accountability implies public reliance. If a business trades on public markets, the complexity of that risk mandates the use of full IFRS accounting standards, regardless of how small its operational footprint is. This logic applies individually within corporate group structures as well. A private subsidiary can prepare its own financial statements using IFRS for SMEs, even if its parent company is a publicly accountable corporation. Eligibility is driven by the nature of user reliance and market exposure. Arbitrary size thresholds are irrelevant. Traded debt and equity is a clear-cut boundary, but there is a second trigger for public accountability: holding assets in a fiduciary capacity for a broad group of outsiders as a primary business. We must separate incidental custody from primary fiduciary custody. Travel agents or schools holding daily deposits is incidental.
It does not trigger public accountability, but banks and mutual funds manage public resources as their core operation. This primary custody instantly disqualifies them. For auditors and preparers, misjudging this boundary is a severe error. Using the SME framework when an entity is publicly accountable invalidates the entire basis of financial preparation. Holding cash temporarily is a normal byproduct of commerce. When managing public risk is the core business itself, the entity transcends the SME framework. Once an entity accurately qualifies, we have to look at how the standard processes financial data differently from local alternatives. Take a major asset purchase. The tax path uses accelerated deductions to shrink taxable value. Management simply records raw cash outflows. But IFRS for SMEs requires capitalizing the asset, assigning a useful life, and testing for impairment to reflect true economic consumption. A frequent trap for practitioners is allowing tax-driven assumptions, like prescribed depreciation rates, to bleed into the general-purpose financial statements. The accounting basis must remain distinct. At the same time, the SME stream deliberately filters out the noise required by full IFRS.
You won't find requirements for exhaustive segment reporting or complex market risk sensitivities. The standard removes capital market noise, but it aggressively protects the accrual principles a lender needs to accurately assess credit risk and asset recoverability. Because it requires fewer disclosures, some treat a proportional standard as a weak option that permits arbitrary accounting. The third edition explicitly rejects lazy reporting habits. It shifts the requirement away from copying long, generic policy templates toward identifying material accounting policies that apply specifically to an entity's actual transactions. The standard demands rigorous professional judgment. Management must systematically evaluate difficult areas like going concern, provisions, impairment, and fair value measurement. The framework does include specific undue cost or effort exemptions to balance the reporting burden. However, these are not blanket permission slips to avoid difficult math. Using an exemption requires formal documentation proving that the cost of calculating the data substantially exceeds the benefit to the end user. Proportionality is designed to relieve unnecessary administrative burden. It forbids sacrificing faithful representation for the sake of convenience. Every rule in this framework leads back to the external decision-maker sitting outside the building, relying on the numbers. Commercial lenders leverage standardized SME data to perform accurate covenant testing, set supply chain finance limits, and confidently score credit. Minority investors rely on it to strip away owner-specific expenses. They use the standard to assess true maintainable earnings and dividend capacity, free from the distortion of hidden related party transactions. We return to the concept of the reporting framework as a bridge between private enterprise and external capital. That bridge is held up by three specific pillars: consistent recognition, accurate measurement, and targeted disclosure. On a macro level, this enables cross-border comparability. It allows a bank in one jurisdiction to confidently assess a supplier in another, while protecting the market against selective reporting. Properly applied, IFRS for SMEs functions as a universal language, grounding private enterprise in professional credibility.